So, can you hear me? Can you hear me? That's good? Yeah. Okay, great. Okay, so colleagues, ladies and gentlemen, welcome to this flagship event. Thank you all very much indeed for coming to this event in the joint MDB pavilion. This one led by the Asian Infrastructure Investment Bank. My name's Danny Alexander. I'm the Vice President for Policy and Strategy. So the COP27 this year is really regarded as the implementation summit. And one of the core goals is to scale climate finance. So the topic of today's panel is about scaling climate finance, bridging the gap between concessional and private financing. We hear a lot about the scale of the financing challenge, the trillions of dollars per year that need to be mobilized for climate finance. And particularly in developing countries, the challenge of how to mobilize private sector finance alongside government, multilateral development banks, concessional finance, philanthropic capital, and so on is a crucial challenge. And so the purpose of this discussion, where we have a distinguished panel with us, is to try and get into those questions and to understand better how we can bridge the gap, how we can bring private sector finance, concessional capital, multilateral development banks, philanthropic organizations together to mobilize finance at the scale that is needed to meet this challenge. So on our panel with us today, we have Anne Valentine Andrews. Anne is the Managing Director, Global Head of Infrastructure and Real Estate within BlackRock Alternatives. Welcome, Anne. Thank you very much indeed for joining us. We have Mark Dooley, who's the Global Head of the Green Investment Group at Macquarie Asset Management. When I was in the British government, we set up the Green Investment Bank, which Macquarie acquired a few years back, and have taken it from strength to strength and really multiplied and enhanced the impact. So delighted to have you with us, Mark. We will shortly be joined by Dr. Rajiv Shah, who is the president of the Rockefeller Foundation. But before we get into the panel discussion, it is really my honor and pleasure to invite the president of the Asian Infrastructure Investment Bank, our president, Jin Lee Chun. He's the president and the chair of our board of directors, and has been leading this institution since its foundation, and indeed led also the setup of the organization before that. So President Jin, I'd like to invite you to give some opening remarks. Thank you.
Okay, yes, very good. Thank you, Danny. It's my great pleasure to welcome you all to Asian Infrastructure Investment Bank's flagship finance event on scaling climate finance, bridging the gap between concessional and private finance. If humanity's effort to limit global warming to within 1.5 degrees is to be successful, annual climate financing must grow to 4.5 and 5 trillion US dollars annually by 2030, up from $653 million in 2020. So according to the IPCC, while sufficient capital and liquidity exist globally to meet this task, current financial flows are 3 to 6 times lower than what is needed. Particularly for developing economies, clearly, much remains to be done in mobilizing private capital to meet the formidable challenge we have to address ahead of us. The path ahead will be winding uphill, very arduous. The current macroeconomic context will further squeeze the availability of public finance and sap the private sector's already weakened financing appetite. Much to our chagrin, we now find ourselves in an era of multi-layered crises with dubious energy security, unceasing pandemic disruption, and ever more frequent natural disasters. impacting developing countries, which represent the majority of our bank's membership. As tragic recent events in Pakistan exemplify, many Asian countries' geographical situation and topography render them vulnerable to the wrath of the climate change. All too often, the impact of climate change has exacerbated these countries' fragile macroeconomic situation and higher indebtedness. As highlighted last year at COP26, the imperative for scaling up the role of private capital in climate finance for developing countries has never been stronger. While total private sector financing is increasing, including equity, commercial debt, and through capital markets, it remains woefully insufficient. Barriers to increasing private sector financing in developing countries are well known. What constitutes the major impediment to private sector's financing is a less than accommodative and supportive policy, regulatory, and institutional environment. At the same time, bankable projects in short supply remain a major constraint. This phenomenon is both the cause and effect of the disruptions wrought by the COVID-19 pandemic and geopolitical tensions. As a new member in the MDB family, we in AIIB do not pretend to have a special role to play in helping to roll back these barriers. However, MDBs do take this issue seriously and have been actively deploying finance and developing technical frameworks to address worsening climate change and its devastating impact. We do this with a keen sensitivity toward developmental equity and try to assist our members in mapping out their national-specific transition pathway. Keenly aware that MDB resources are very limited relative to the vast needs, we have been doing our utmost to maximize capital mobilization to the extent possible. This means making sure assets are financially viable. We must also create and anchor financing products to increase the supply of investment opportunities and foster an investment environment that supports mobilizing capital for developing countries at a large scale. Concessional finance will play an increasingly critical role for growing private sector involvement in climate finance, particularly for low-income developing countries. It is gratifying to see that sources of concessional finance for climate change have been increasing and diversified. MDBs have a critical role to play in bringing development partners and other stakeholders together so as to achieve a more effective deployment of concessional finance aimed at maximizing private capital mobilization. MDBs can bridge the different objectives of these parties. For example, between development and impact expectations with commercial and financial needs. They can ensure limited concessional resources are used to the greatest effect, for example, in project preparation or simply to act as a blender of financing. Our bank is actively mobilizing private sector capital in a number of ways. We are going beyond just the financing mitigation and adaptation projects to also facilitating private finance into new markets across Asia. We do this by de-risking projects, by providing longer tenor loans, first loss investments, and guarantees. By the end of 2021, together with our partners, we had financed over 4.5 gigawatts of renewable energy and invested in energy investments that saved over 26,000 gigawatt hours of energy. We're also mobilizing private capital by providing equity and debt to fund managers and financial intermediaries to spur broader investment into developing assets, technologies, and frontier markets. by creating products such as green bonds and asset-backed securities, we seek to broaden investment even further. AIIB has approved $1.2 billion of investment in green and sustainable bonds across Asia, including the Asia Climate Bond portfolio in less than 3 years. Our bank's sustainable bond framework has also gained a strong investor base with a portfolio of $8.5 billion in issued bonds, with 100% of the proceeds aiming at sustainable development goals. We have also implemented sustainability-linked carry schemes to incentivize increased climate financing from funds and financial intermediaries. At an upcoming AIIB event this Friday, we will speak in greater detail on financing the supply of climate technologies. And on Monday, next week, we will focus on the role of resilience bonds in unlocking capital for climate adaptation. Scaling the role of private capital in climate finance will require new partnerships. That way, our bank is pleased to announce 2 new partnerships. One is joining the Rockefeller Foundation's Global Energy Alliance for People and Planet, a platform designed to accelerate the energy transition in over 60 developing countries by bridging the gap in financing for low-income countries. The other is becoming one of the first anchor investors to the International Renewable Energy Agency, Energy Transition Accelerator, financing platform, in a multi-stakeholder climate finance platform to advance energy transition with low-carbon technologies across all developing countries. Shakespeare wrote in King John that strong reasons make strong action. The reasons for us to be together today are strong and galore. And so I look forward to taking part in the action ahead. Our individual actions may be small, but their combined impact will be Herculean. With that, I'd like to hand over to Sir Danny Alexander to moderate the discussion with our distinguished panelists. Thank you very much.
Thank you very much indeed, President Jin. Strong reasons demand strong actions. This is a great expression to define actually the whole purpose of this COP27, let alone our discussion here on this panel today. So I would like to follow on from what President Jin was saying, and maybe to start with you. I mean, one of the points that President Jin made was about the macroeconomic context and the challenges that is presenting in terms of the flow of investment for climate finance into emerging markets, and yet the challenge and the scale of resources that are needed to deliver the climate action in emerging markets especially is enormous. How do you reconcile those two things, and how do you see the role of private sector finance and concessional finance, MDBs, coming together most effectively to achieve those goals? I know within BlackRock you've had a number of successful initiatives already, so also keen to hear some of your experience. And let me just pass the microphone to you, and we'll see if someone can bring another one in a moment. Thanks. Over to you.
Great, thank you very much, Danny, and the President was very inspiring open remarks. Thank you. This is my first COP, everybody. I zoomed in last year, so I'm very happy to be here in person and to be experiencing this, so thank you for joining this panel. That was a big question, but I'll just take a step back a little bit to sort of frame some context so people know the lens that BlackRock is looking at this topic. And you know, I'm actually a pretty positive person. And I was at an event last night, and I was talking to some people about the evolution of COP and where we've gotten to, and the fact that we're talking a lot about the big issues, you know, which weren't being talked about 10 years ago. You know, BlackRock, when we actually started investing into infrastructure, we started with renewables, and that was about 12 years ago. We've got David in the audience who runs our renewables group. But it was strange at the time when that happened, right? It was very strange. It was not normal. And a number of people we met with when we were raising that first fund said, we think this is going away, right? This is a subsidized thing. It's not going to live. You know, I'm not going to give money to this fund because it's going to be gone, right? So that was not very long ago. Welcome, come and sit down. That was not very long ago in the scheme of time, right? So only 10 years ago, people were wondering whether renewables were going to be a thing. There was no talk of funding emerging markets. The concept transition finance didn't exist. We weren't talking about net zero. All of these things didn't exist just 10 years ago, right? Which is not very long ago. So, you know, thinking about that, right, we started building, we've got an $80 billion real assets platform. We started building it with a renewables fund, right, back when it was strange. And so you think about that, the amount of capital that we've been able to mobilize, and based on the funds that we have as well as debt that we've raised, we've mobilized about 55 billion into the transition so far. And a very, very small portion of that is emerging markets. So, you know, the fundamental question that we've got here today is, there is a huge amount of capital out there, right? There's a huge amount of capital out there. We raise money from all of the pension funds around the world, all of the sovereign wealth funds, all of the insurance companies, many of whom here representing today. But it's a question of risk mitigation and risk underwriting, right? The emerging markets, even though the demand for building new projects is enormous, and we all know the figures, we can all throw out trillions of dollars, the capital at the moment cannot flow there because of the risks, right? And from a BlackRock perspective, we're in the business of raising capital from folks and putting it into projects that they want to invest in. That's our business. And so we're always talking to the market and working out where the market wants to deploy money, and then doing our best to deploy money and generate returns. And so we do that across a whole spectrum of different products, from renewables, which is our pure green strategy, to what we call a transition fund, a sort of a brown to green fund that's investing into gas, that's investing into, you know, other tricky things, but making sure they're going to become green over time. And we also have a very large debt business which invests across the spectrum. So, you know, that makes up, you know, over half of our AUM. And so we have a very small part of that 80 billion dedicated to, you know, emerging markets, developing economies. And how did we do that? How did we actually sort of start focusing on the developing markets? It was actually a conversation which happened with the French government and Larry Fink back a number of years ago, where the challenge that you just talked about was put on the table. Hey, BlackRock, can you put together some capital to help us to mobilize into the emerging markets? And we did what we know best, which is pull together a structure, because this is what we do, right? We go to institutions, we structure up a fund, and then we put people on the ground and we deploy that. Sounds easy when I say it like that, and then we manage it for many, many years and hopefully sell the assets and make money for our clients. That's effectively what an asset manager does. So, you know, we looked to partner with development organizations to take first loss, right? Because our institutional investors cannot come into deals in the emerging markets without that first loss support. So we convened a bunch of those development banks, and then we went about raising capital, and we created what we call the Climate Finance Partnership, which is a vehicle to invest and build assets in the emerging economies, to build renewable assets. And it has quite an innovative structure. I mean, I think we can go into it in more detail when we're talking, but you know, one of the things I think is important is, how do we think about this in true partnership, right? Because no one can do it alone. It's impossible, right? We are in the business of underwriting risks, FX risk, interest rate risk, country risk, all these sorts of risks. But some of the risks in the emerging markets we can't underwrite without the help of development banks. So, you know, we created this vehicle. It was very innovative. We ended up raising just under $700 million to invest into building, renewables in the emerging markets. It's a fantastic structure. It's something that can be replicated. We hope people replicate it in order to deploy more capital. But I'm pretty positive about where I see. I mean, there's a lot of bad news out there at the moment. We can talk about that. But I'm very positive in terms of where I see, just stepping back, where I see the direction of travel over a decade. And talking about the war in Ukraine, obviously energy security is now a really big topic as well. We at BlackRock view the war as ultimately speeding up many of the decisions which would have been made eventually anyway, right? So it's going to be very, very bumpy as we go along the road, but we're certainly seeing higher engagement and people making tougher decisions now in terms of moving away from hydrocarbons. So I think that's a positive thing. Not the war's not positive, but positive in terms of the decisions that people are making in the long run. So, what I would say, sort of stepping back, I see a positive trend. And we're working very closely to be finding more capital that we can invest, just because of the sheer size of what needs to be done in the coming decades is impossible to do alone. And we want to do more of that on behalf of our clients, on behalf of building a better planet. So I'll leave it there. I might hand it back to you or hand it over to. We've now got a new panel member as well, so welcome.
Thank you very much, Anne, and welcome, Dr. Rajiv Shah, President of the Rockefeller Foundation. And I'd say to the people standing at the back, there are plenty of seats here, so please come and sit here. These rooms always fill from the back forward. There's actually a few seats here, so please come and take a seat. The panel won't bite, but you're welcome to come and take a seat rather than standing on your feet for the next 45 minutes or so. Thank you. Welcome. And also we have an online audience. I should say this session is also being live streamed. So welcome also to the online audience. So Mark, picking up from where Anne left off. She said that despite all the challenges, which are enormous, you're I think relatively optimistic, at least about what can be achieved through partnership. How do you see it from the Green Investment Group, and what are the challenges that you see, and how do you use concessional financing and other kinds of financing to help make the emerging market investments and projects work in the way that Anne was also talking about from BlackRock's perspective? So over to you. And could I ask if is there another roving microphone, please? If there is, they could be brought here. Otherwise, we'll just manage with one. Okay, Mark, over to you.
Thanks, Danny. And we still have 4 more chairs up the front, which we'd very much like to syndicate, I think. So thanks, Danny. Some initial context about Macquarie and GIG. Macquarie is an Australian investment bank with great focus on infrastructure and energy. We're the largest infrastructure funds manager in the world, and on commodities. So that's us generally as a financial institution. Within that Green Investment Group, which we're very pleased to purchase from the UK government and merge with our existing renewables business, is our renewables investing arm, bought from the UK government those 5 years ago, and recently moved from the balance sheet of Macquarie. So everything we've done until earlier this year was using balance sheet money to our asset management business. A move to facilitate new scale in what we do, to effectively make limitless, harnessing all the forces that Anne has just talked about. So there's us voting with our feet that the volume of what needs to be achieved here required a different platform for us. In terms of the character of Green Investment Group as a business, it's evolved, and that evolution is important for this discussion. We used to be a project sponsor, there with equity to build the project. About 5 years ago, maybe a bit longer, we recognised that there was lots of that kind of equity in the world. And that if we wanted to stay distinctive, we needed to do the scarce thing. And the scarce thing was investing early and higher risk, deeper niche expertise in developing projects, in creating that moment where the question, where's the capital coming from, can legitimately be asked. And that was the way that we have changed our business. Today, we've made a further evolution and we've pushed that development out into a portfolio of development companies that we now own. So I think of the business I run as being ownership and creation of a series of development platforms that we have as a portfolio. Examples of that, earlier this year we created Corio, which is one of the world's largest offshore wind developers. And just last night we announced the creation of a company called ECU, EKU, that is a global utility scale battery storage developer. That's how we want to address niche expertise and the need to be able to have scalable volume. Across all those development platforms, we have quite a bit of involvement in emerging markets, active in Brazil, an early mover in Taiwan, India, Vietnam, and others. And we collaborate with MDBs in many of those markets. What we find is that where there's applicability for MDB capability, it can really change the funding task. And if you're trying to do a large offshore wind project in Taiwan, for example, and you need debt in the billions, having an MDB come along and provide half of that debt transforms the equation, absolutely transforms the equation. Instead of wondering where the nth bank is going to come from in order to fill out your ticket, you've suddenly got half of the equation solved, and you're finding yourself in a position where your confidence and everybody's confidence that this is going to get funded, is going to happen, is suddenly strongly in place, and it's profound. It makes a huge difference. What I do want to say, though, is that when we talk about these trillions of dollars, and even the comments I've just made there, we all know that all of that investment happens, or virtually all of it happens, in the form of projects. And looking at the people in this room, we all know that whether we're operating in a developed country or an emerging market, projects only happen when a lot of boxes get ticked, when a lot of steps on the journey to having that investable project have been executed satisfactorily. And we also know that MDBs are, they have their specific mandate to address specific risks, but MDBs are no more relaxed about the need to tick all of those boxes than any other capital providing institution. All of that work has to be done. And I guess the thing I'd say is I really look forward to the day when, and I genuinely do look forward to the day when the number of well-developed projects that have ticked all of that boxes and the capital requirement of those projects creates a really visible gap of capital. Because at the moment, to me, the constraint is how many projects have gone through all those steps and present us that problem, present us that challenge, where is the money coming from? Now, we really need to hit that day. We need to find that point in time where incrementally one market after another becomes capable of generating projects that are ready for capital. But all of these capital providers we talk about are very sophisticated and know whether they've got a properly structured project in front of them or not. And if they don't, even the great panel of MDBs we can see on the wall there, they can't support, they're accountable to their stakeholders, they can't support projects that haven't hit that. So to me, the great focus is on how do we help countries accelerate the process of becoming able to develop really investable projects. And that's a joint activity. I'd call out the JET-P initiative that's being used for high coal burning countries to transform them. That's an initiative that feels right in the way that it's bringing together a concentration of expertise to bust through the systemic problem so that we can have the capital challenge at the end of that process. I'll call out one further thing. Just we have a collaboration with GCF in India in e-mobility. They've allocated $200 million to us. We'll find another $205 million and then debt fund the balance to create essentially a new financing business for e-mobility, so looking at buses and charging for that market. That's a first loss facility that we've been given by GCF. I think it's a very powerful demonstration of the nimbleness of that MDB mandate that GCF brings, and points the way forward that to do a lot of these things, we're going to need to step outside and take advantage of traditional formats of MDB interventions and be able to do things that are flexible and bespoke to the particular needs of the equation. I'll pause there, Danny.
So, Mark, thank you very much. And actually, two quite different perspectives in a way, although the issues are overlapping. So I think there's a few things to discuss further. But first, I'm delighted to welcome you, Dr. Rajiv Shah, President of the Rockefeller Foundation, and I'm really grateful that you can be with us. And in his opening remarks, President Jin was referring to the Global Energy Alliance for People and Planet as one of the initiatives that you're involved in, that we're signing, as AIIB, signing up with, I think today, actually. So we're delighted to be part of that, and I think that the role that philanthropic capital is playing in this space is emerging very strongly and increasingly important. And so your observations on how we can bring these different pools of capital together in order to achieve the scale of investment that's needed in climate change in emerging markets. We would love to hear your opening remarks, and then we'll open up a bit of a discussion. I'm afraid we have 10 MDBs involved in this pavilion, but only one microphone. So let me pass it to you.
Thank you, Danny. Thank you, and good morning, everybody. Thank you, Danny and Mark. It's great to be with all of you. President Jin, thank you for your extraordinary leadership of the AIIB, and I can assure you we are extremely excited to be entering into partnership with you on behalf of the Global Energy Alliance for People and Planet just in a couple of hours. So very exciting day for us today, in part because of that great partnership announcement. I think it's worth just zooming out a bit and describing why we're here. We're here because 3 degrees Celsius or 1.5 degrees Celsius is fundamentally a choice we can make if we choose to work together. And that's what brings, I think, most of us to Sharm el-Sheikh. But we should also recognize that whether the next decade for developing countries is a decade of inclusive growth and human development progress against the Sustainable Development Goals, or whether it continues the trend of the last few years of unwinding progress in poverty, in hunger, in health, in energy access, is also a choice. And frankly, as a global leadership community, we are choosing to allow 3 degrees warming to take place, and we are choosing to allow a tremendous amount of human development to be unwound and go backwards as we look to the future. And it's not because of any lack of commitment from those in the room, but it's fundamentally because the scale of the challenge is too big to tackle alone, and we still try to do too much working as individual institutions as opposed to genuine global alliances and genuine global partnerships. Just to put it in perspective, in energy alone, as we're talking about energy transitions everywhere around the world, 3.6 billion people in 81 countries are fundamentally economically constrained primarily by ineffective energy access. 750 million of those effectively don't have any real productive power. You know, basically they are in subsistence poverty because they are not participating in using power to improve their labor productivity. But the rest of the 2.5 billion, 2.7 billion of that group live in communities where they get power, but it's expensive, it's erratic, it's unreliable, and it doesn't allow their businesses to compete in a modern economy where you can buy always-on renewable power in many industrial nations at 10 cents, 8 cents, 12 cents, 4 cents a kilowatt hour, depending on where you are and in what context. So we have a challenge, and the challenge is dramatically improving access to energy for 3.6 billion people while also rapidly transitioning the energy economy. And then you can ask yourself, well, is business as usual generating that outcome? Well, this year we'll have more coal online than last year. Last year we had more coal than the year before. For the countries that are the focus of this COP, the developing countries in particular, that's the fastest rate of growth of coal anywhere in the world is in developing and emerging economies. And so the answer is obviously no. Doing what we're doing is not getting us there. This is why last year we launched the Global Energy Alliance for People and Planet. We amassed $11.5 billion in commitments from many of the acronyms and logos you see on that wall, but also $1.5 billion of pure philanthropic capital that could move fast, make grants, and try to unlock progress in a differentiated way. And in fact, we've done that. In just 12 months, we've built out a team of almost 75, 80 people. We are active in 12 countries, expanding to 20 next year. We are doing that all based on country plans and country priorities. We've actually already committed and spent $350 million out of the pure grant fund to accelerate projects that are about $3 to $4 billion in total cost and value. And when you actually see what's happening, large-scale grid storage batteries being put on the grid in Malawi so that that country can have a huge share of its energy growth come from renewables. 10,000 solar mini-grids being built in Nigeria so that people who don't have access to power can have access to always-on renewable power. Tens of thousands of rooftop solar enterprises being created on behalf of small and medium-scale companies in India. Large-scale electrification of small-scale farming systems in Ethiopia. These are what the projects look like on the ground. So we are very excited that the Asian Infrastructure Investment Bank, which potentially moves faster and in a more deliberate way on infrastructure in particular. We are eager to enter into a partnership with you to both learn and to share in the aspiration forward. But I just want to highlight that you just heard about how blended finance can effectively support these projects and support making them happen. We have a blended finance instrument, the Global Energy Alliance for People and Planet. I would argue it's the only genuine alliance instrument that exists. And I'd also argue if you look at the last 10 or 20 years, just trying to piece together blended finance project by project has been exceptionally slow and ineffective against the task at hand. So I'm excited to be here. I think the future are building more of these types of alliances, and the future for energy transitions in particular is joining this one and making it highly successful.
Thank you very much indeed, Raj. And you can be sure that from AIIB's point of view, you know, we're joining this to make use of the money to deliver the project. So thank you very much indeed. So there was actually quite a lot of, I think, quite provocative points that were made in the panel discussion. So I want to go back to the panelists briefly, and then I will open it up for some questions from the audience. So Anne, when we were discussing before, you were saying, and echoed what Raj just said, you know, business as usual isn't delivering to the scale. New models are needed in order to scale up the finance. And you made reference also to the climate finance partnership that you announced last year. I'd be very interested to know more about how that is going, and is that, do you think that's a model that could be scaled further? And what are the challenges that you see, particularly to deploy that capital into emerging markets?
Yeah, no, very good question. And again, going back to basics, what we do as a business, and ultimately we are doing very similar things, right? We're looking at individual countries, we're assessing how those countries operate from a political perspective, from a regulatory perspective, from an FX perspective, from all sorts of perspectives, because we're investing as long-term investors into countries. So when we go into a country, we have to have a very, very clear view on what's going to happen. The models we draw up to predict cash flows are actually very detailed. So we have to have a high degree of certainty that we're going to be able to pay back that not only the capital that we have, but with a return that's somewhere between 10 to 15%, depending on where we're doing it and what the risks are associated with the project. So coming into a place, we have to have a pretty good idea of how it's all going to work, right? We're infrastructure investors, we're not VC investors, we're not PE investors. So understanding everything about that particular country, it takes a lot of effort and it takes a lot of work. And typically we at BlackRock only invest into a country when we have boots on the ground, right? We really want to understand everything about that country. We employ local people who've lived in the country for a long time, who have connections into governments, strategics, all sorts of things, right? So it's a very big commitment for us to go into any country. I was having this discussion with someone from Egypt last night, right? You've got to really understand a country inside out and know that when you're putting capital in the ground, it's going to have a good result over the next 10, 15, 20 years. So it gives you a bit of a feel for the hurdle that we have to step over as a private investor before we deploy capital on the ground. So all around the world, we have boots on the ground. Our business has 450 people, all living across 30 different countries. So we come to the emerging markets, right? And we talk about climate finance partnership, and we are looking at emerging economies. So we're looking at places like Africa. We're looking at the Philippines. We're looking at Vietnam. We're looking at places that we traditionally, as BlackRock, have not had people on the ground, right? BlackRock is mostly a developed markets business, right? And when we do have offices in emerging economies, they tend to be representative offices, right? Or sales offices. So from an investor perspective, we feel very uncomfortable when we don't have people on the ground who know how it works. And everyone knows this world is a very different place wherever you are in the world. So we're uncomfortable when we don't have people on the ground. So, a big part of what we've been doing in building out the climate finance partnership is supplementing our team. Now, we already have a very big team in Asia. We already have a very big team in LATAM. They're places that we're already operating. But we didn't have anyone in Africa, for example, right? And so one of the first things we set about doing when we raised the capital was looking to hire people so that we have representatives on the ground who we're employing and who we trust and who can be a fiduciary on our behalf, because that's the essence of our core. Is we're a fiduciary investing other people's money, not our own, to create the return that they want and what we've promised to them. So, some of these sort of practical things, I talk about hiring someone. It's hard, right? Because you've got to go out, you've got to find individuals, you've got to interview them, you've got to work out who's going to be thinking the same way as you, who has the same culture, and you're doing it trying to find that person when you haven't really been in that market before, right? So I'd say hiring, excellent staff and making sure that they have the same culture, the same investment mindset, and that they're going to do what you want on behalf of clients is a hurdle. We've now done that. We're building out our team. And then I just say, in terms of, picking up on the point we just talked about, finding the right projects where not only the project works and stacks up in terms of the model, right? With the concessional capital, I mentioned we have the concessional first loss capital. But then also, it's going to be operated by people who you trust, who are trustworthy, who are not going to be doing anything untoward or illegal, and people that are going to be able to pass all of the stringent BlackRock controls. It's a lot, right? That we have to make sure we can do all this. So I'd say finding the projects, finding the people to operate those projects, and then also finding the people on the ground who can manage them the way we want. So look, we're BlackRock, right? So we see everything that is out there. Finding pipelines of projects is not an issue, right? We have hundreds of things that are brought to us, but it's picking the right projects that are going to have the impact and the additionality that we're looking for, but are also run by and set up by individuals that we trust and that provide all of the different BlackRock ticks, to talk about ticking boxes. I'd say that's difficult and takes a lot of effort. But we're about to announce our first project in Africa. It's a wind project. And, so I'd say we are making a lot of progress. Now, I'd like to be able to say that we deployed a lot more and that we're making a lot more progress. But, the concessional capital and the partnership, it does work, right? That does work, and that has enabled us to bring in other capital and to bring in capital that's focused on the future and focused on additionality. I mean, one of the things that we've done in this fund is also to create a council of sustainability experts, because we have to do an extra level of reporting for this fund as well, and that's something that we should talk about in a bit more detail. And we're learning and we're teaching our investors in that fund at the same time around this additionality concept. So, look, I think this is it's a structure that works. It's obviously innovative, and that there haven't been a lot of them done. We believe that we can scale this up to multiples of what it was beforehand, but it still needs to scale more. So I think the on the ground, finding the right projects, then mapping that with the investors who we know are wanting to invest and develop the world more. I think it's a good model for us to continue to copy. And so when we come back for the second fund, we like to raise multiples of funds. That's really how we build the business. So getting the first fund done is always the most difficult thing to do, right? Where the first fund is always, I always say everyone should raise a first fund. It's incredibly challenging. And so now that we have the first fund and the model's working, it's going to be much easier then to scale it up again for the second and third funds. And then you can have multiples of that, over time.
And thank you very much. And I have to say, having been Vice President at AIIB since the formation in early 2016, some of the challenges that you describe about finding the right people, building the expertise, having the right rules and frameworks in place to ensure the integrity and fiduciary and so forth, as well as the environmental and social standards, those things do take time. They take frustrating amounts of time, given the fact that we, as Raj was saying, we don't have much time. But nonetheless, it has to be done. It has to be done. Has to be done properly. But Raj, I think you wanted to come back on something that Anne said, and then I will come back to Mark afterwards. So, Raj.
Yeah, I did. I don't know if it's okay. I have a question for Anne and a comment. The comment is, I think you said 10 to 15%, and if you kind of layer in currency risk protection, my sense is the current way a BlackRock or any other global investment fund might raise its fund is relatively higher cost capital than, say, local currency sources of funding. And what we find in our Global Energy Alliance projects is local currency guarantees and things that unlock local currency financing appear to be more fruitful from a project capitalization perspective. I guess my question is, could you imagine BlackRock, or maybe for you, Macquarie, raising a fund that is sort of in partnership with AIIB or Rockefeller or the World Bank, or you know, kind of genuinely in collaboration, because those are the institutions that have so much expertise at doing what you just described, but in the subset of developing countries that are, you know, a level below where I suspect most of your capital currently goes.
Anne, would you like to have a quick go at that, and then we can agree to set up the fund now while we're here on the platform?
Well, I mean, again, sorry, you know, I think the climate finance partnership is that. I mean, it actually is that, and it is teaming up with development banks, and it is focusing on things that would otherwise not be funded, and so I think it is very different. It is very different to our normal funds. You know, our normal funds are, you know, here's a set of assets that we're going to go after, and come and join our funds. But there's no, you know, there's no other capital helping those assets become viable or investable. Exactly. So I think the climate finance partnership is that. It is exactly that, in partnership with the development banks. Creating this structure where there is this first loss capital. And what's interesting about it too is it's not just granted or gift money, or so what happens is it's got the capital that comes in is the first loss capital, but then after a period of time it actually they get paid back a return over as well. So it's innovative in that way. Yeah, I don't know if you wanted to say anything on that.
If I may, I would come to Mark. So I don't know if you want to comment on this in response to Raj's question. I would also say, ask you maybe to amplify something that you said earlier on, which was about the flow of good quality projects, and that you saw that as being a challenge to scaling. You know, and you're setting up these specific enterprises in relation to battery storage or offshore wind, as I understood it, to develop more expertise to bring forward more good quality projects. Anne mentioned that finding the underlying projects is not so much of a challenge. But I wonder if the distinction is just to do with how you deliver the projects at the scale and volume that is needed. So please respond to Raj. But if you could also say more about your observations on that, on the point that you made earlier, I'd be very grateful.
You know, just quickly on Raj's point, particularly on currencies. That is quite a stubborn issue that we confront in going into new markets, and the response to it tends to be bespoke from one country to the next, one solution to the next. You know, there are some countries that are now very, you know, Turkey, for example, for many years has had contractual structures that involve currency adjustments on a year-by-year basis, which do just enough to get us through worrying too much about the currency fluctuations. Just enough, but that triggers it. That means those projects get international capital attracted. So, okay, there's one answer, and it's delivered on a basis that's acceptable to them. So, you know, a compromise in the middle. That's on a project-by-project basis or a country-by-country basis. The kind of global fund solution that Anne's talking about is revolutionary. If you've got that happening, then that's really impressive. Coming back to your question, Danny, look, I don't know if there are people in the room who've got really well-developed, well-structured projects that don't have capital, or where it's all solves down to one particular funding challenge. There's a sovereign risk or a currency risk or some other feature that an emerging market project might have. Then that's really exciting. We should call it out now and workshop it, and get it, because we'll get it done. projects that are properly developed and ready to be invested, but have that one issue, you know, we could get together and fix that today. But my concern is, and my observation is, that there aren't very many of those. That the big odyssey, the big challenging journey of turning the idea of a project into a project that's at that point where it's ready to be invested in, or ready to be invested in, but for one emerging market type problem that an MDB can solve. When we get that situation, we as a group, we will fix that. We will make that project happen. But we don't get to that point. And the reasons we don't are so complex and deep, and yet urgent that we solve them. And I think the only way that we bust through them is by collaborations of local bodies and the kind of international players that are represented in this room, coming humbly to those markets to help, but also having a very realistic view on what I keep saying it. All of this progress happens when projects achieve financial close. Simple as that. If we can't get projects to financial close, the investment doesn't happen. And unfortunately, financial close is a very high bar. You've got to jump through all these things, and we have to help these countries go on that journey. And then, you know, we get to that fantastic day when all of the capability in this room can bring the capital and solve those one or two problems that are emerging markets, distinctive problems, that we're all set up to, or the MDBs in this room we're all set up to develop, to respond to. But the journey is really difficult, and we've got to get better at helping these countries to do that.
Thank you very much. So we have also an audience here. So if I may, everyone's been, I think, listening very attentively to the really rich discussion that we've been having. There may be some questions. So I want to give a chance for...
Or maybe some projects that we could help
so
fund today.
If anyone wants to answer Mark's challenge and bring forward a project, that would be great. But I see three, so I see five. Okay, there's a lady at the back, and then I see a J. Co. from Lightsmith there, and then a lady at the front. So we'll do those three first. So we've only got one microphone. So this is...
we can share this.
Yeah. So, okay, I can use my loud voice. Lady at the back first of all, and then Jay, and then the lady in the second row.
Thank you very much for your presentations. You really enlightened me about the solutions of achieving sustainable development and also putting us into the right direction. But I'm still curious about, is degrowth possible under, without environmental justice, or and how MDBs can collaborate with businesses and foundations and NGOs, even though leading universities in the way of achieving sustainable development. Thank you.
Thank you. And could you pass the microphone to just Jay there? Yeah.
Hi, thank you for a great panel. And President Jin, it's wonderful to hear your opening remarks as well. I'm J. Co. from the Lightsmith Group. We're actually a joint Rockefeller and AIIB project, the first adaptation and climate resilience investment fund. So we're co-invest with BlackRock as well. So there's many different connection and touch points here. So it's wonderful to hear such a focus on being very creative and practical with BlackRock and Macquarie and others really engaging the MDB community in attacking the de-risking and really focusing on the energy transition. So as a resilience and adaptation fund, which has been launched with the real support of Dr. Shah and the Rockefeller Foundation and the leadership of President Jin and many others around the table, I'm just curious to hear your thoughts about how adaptation and climate resilience can also be incorporated into the energy transition strategies that we're seeing the opening impact of climate. It will be at least 1.5 degrees of impact that will affect long-term assets like infrastructure. And of the things that are certain out there, I don't know what happens with interest rates or consumer behavior or the war in Russia, with Russia, or all kinds of other things. But in 10 years, if we're sitting here, climate change will definitely have happened and impacted the assets, whether they're real assets, long-term infrastructure, real estate, listed equities, et cetera. And so creating a pathway to make sure that the investment that we're making now will survive and thrive in that environment, I think is really critical. And the leadership of Rockefeller and AIIB and others, I think is really important to that. So we'd love to hear how adaptation and resilience can be an additional strategy or incorporated really into looking at how a climate 2.0 approach to investment in the future will look like. So thank you again.
And then there's a lady in the second row here.
We're going to forget these questions by the time we get to
Danny's writing.
Hi, thank you so much. My name is Karen. I'm from Imperial College London Climate Investment Center. So I have a question about the really fundamental one, and you bring up about risk and the return. So about risk, like about management and measurement of risk for projects, especially for MD involved, it takes time. But for climate issue, the thing is we don't have that much time. So like, how can we make sure we can manage and measure risk faster and then maybe like more accurate, no matter what kind of level? And then second one, following up on return. So we know, like, for example, like solving loss and damage is not about donation. It's also investor expecting for certain level of returns. So now we have new kinds of instruments like carbon market coming up. So would that be something like MDB might find a role here, and how to adapt also, like work with really important part of society not on the table right now, like private sector, more startups, innovations, like smaller scales projects. So about risk and return question. Thank you so much.
Okay, so, sorry, can I have the microphone back?
Oh, here you go.
I'll take this one, then you, okay, yes, I'll use this one.
Yeah,
Okay. Okay, and then, no, give that for the panel. So we'll go to Raj first. Just to say, questions about environmental justice, about building in adaptation and resilience, and about how can we be faster in assessing the risks of projects in order to deliver the investments more quickly. So pick any from that menu that you would like to address. Don't feel you have to address everything, but do you want to go first, Raj?
Sure, I'll address two points. First on climate and on resilience and adaptation. You know, it's interesting when the definitions were all carefully negotiated many years ago, we were in a different stage of this climate emergency. Today, if you travel through sub-Saharan Africa and look at agricultural productivity and food insecurity, there are 4.3 million people teetering on the edge of starvation in Kenya alone right now. You would have to argue that we are in the emergency phase of the climate crisis. And in the emergency phase of the climate crisis, I would argue development investment is adaptation investment. Helping farmers produce more food, building out road infrastructure to take foods to market, creating health and education systems that allow for human capital for growth, and reimagining inclusive growth strategies built on green technology, but inclusive growth strategies is the fundamental way to protect communities from climate risk. So if that's true, then we need to be much more aggressive about investing in development finance, whether it's public-private blended finance for the projects we've been talking about here, or large-scale development finance. And I would say right now, we're actually going backwards. Right now, I'm interested what my colleagues on the panel would say. We see debt crises emerging in 40 to 60 lesser developed countries. We see capital outflows in terms of foreign direct investment to safety, mostly in a strong dollar context. We see currency risk effectively crushing the ability to attract private capital to the kinds of projects we're talking about. And I would argue, much like the period after World War II or the period that led to the HIPC initiative, the highly indebted poor country initiative in 2000, we are facing a moment when a combination of crises, a war in Ukraine, inflation created by an inequitable fiscal and monetary response to the COVID crisis, the inequity of the actual health response to the COVID crisis, has created the conditions where we have to do things differently. And respectfully to the question, I don't think, Jay, private capital is going to come to the solution. When we talk blended finance here, you hear Mark talking about Taiwan and saying 50% MDB financing, 50% private financing. Go to an African project that we support through the Global Energy Alliance. Ashwin might be able to tell you, but if you're trying to put energy storage on the Malawi grid, you're not going to attract a lot of private capital unless you provide 50, 60, 70% public and MDB financing. So I think we have to reimagine the institutions on that wall. We've been part of something called the Bridgetown Initiative to do just that. And to me, that's the path forward. Otherwise, we're facing a decade of not just moving towards 3 degrees warming, but allowing hundreds of millions of people to go backwards in their human development, which every time it's happened has led to massive numbers of episodes of instability, migration, and crisis.
Thank you very much. It's a powerful point, and I think you know, also for AIB, we're a new institution. We want to be part of that reimagining, and part of that, how do we deploy capital in a different way to achieve these goals and stop the going backwards that you described. Mark, would you like to add anything to the questions?
Yeah, and to bring in another, maybe not so visible to this group, potentially sort of departure, bifurcation that's happening right now, I think. In some ways, I'm now an electron salesman, a green electron salesman. We sell a lot of the power of our projects under private PPAs to the corporate world. And I can tell you that 4 years ago, that was quite hard. It was quite hard for us to knock on the door and get into a C-suite in the developed world. Today, the paradigm shifted completely. There's much more demand for green electrons and green molecules than we're able to supply. And this is a manifestation of the fact that the corporate world, the private markets, have woken up completely to the pressures on them, whether it's from their net zero commitments or just from the pressure they feel from their stakeholders, whether it's their shareholders or their customers or the communities that they operate in. They can see the future and they know that they need to reinvent themselves. Now, their awareness about being able to fuel their business in a clean way is high. Their awareness about the resilience and adaptation agenda is not yet where it needs to be, but it's going to get there. So we're heading for a place where the private sector, I think, is going to lead the public sector. It's already starting to happen in the developed world, where this awareness of what the future is going to look like is going to draw the developed world and the big companies that make up its economies in the right direction. I'm not sure that's happening in the emerging markets. I suspect it's probably not. And yet the opportunity and the impact, if we can get that right, a big sort of discontinuity in the way that countries that are less developed to ride this reinvention of what everything looks like, which is what's going on here. You know, take three of the transcendent technologies of this century so far: the iPhone, or let's be brand neutral, smartphone, solar PV, and battery storage. Three things that have become ubiquitous and dramatically cheap. Equip any community with that, and you've connected that community to the world, empowered that community to an economic future that 10 years ago was unthinkable. And to me, the challenge and the opportunity is to find ways to solve that. Those are small elements. A few solar panels, a battery, and some smartphones, and that community, whichever country you're talking about in the world, is connected, has economic opportunity that in some ways is indistinguishable from somebody in London or New York or wherever. So that's an awareness thing, and we're well positioned to work together, not individually, got no chance individually, but working together to change that.
Thanks. Anne, would you like to pick up on any of either the comments from the audience or from your fellow panelists?
Yeah, no, thanks, Danny. I mean, I was going to say two things. Firstly, the adaptability and resilience. We're just on the start of that, right? I think that's sort of where we were talking about ESG and net zero many years ago. So, from our perspective and investors, we're just on the start of that one. What I would say is at BlackRock, we partner with clients all around the world who want to understand what's in their portfolios, what climate risk is in their portfolios. We model different scenarios through our Aladdin program, and I think that's probably the thing that we get asked the most. Tell me what's in my portfolio, tell me where this is going, tell me what changes I can make to make sure that I'm delivering for my shareholders. So I'd say first up, that whole analytics side of it, is big, right? And we're just starting to do that for the private markets, but I'd say it's already well underway on the public markets. And if companies don't have a plan, we talk to them to try and understand what their plan is and push them to have a plan, because climate risk is investment risk. This is happening. So I'd say that topic, adaptability, I think from the investment landscape, I can say we're just on the start of it, and which I think is positive. And so I think the other one was in terms of the justness and the fairness. And this is again where I'm optimistic, even though all of the bad things are happening, as I sort of started my comments, just because of the fact that we're having so many of our clients who have made net zero commitments, right? So many. I think it's 70% of our clients have made net zero commitments. They're not for nothing, right? Like people are speaking up, people are making these commitments, and people are realizing what it takes to actually deliver on them, right? And so BlackRock, and that's why I love this being the year of execution, the year of implementation here at COP. BlackRock spent the last year and a half creating a whole working plan that we're here for the how, right? Like we're not just talking about commitments anymore. How are we actually doing this? How are we implementing in clients' portfolios? How are we helping people make decisions? Because enough of the talk. Like we're here for the how, and I really like that. It's kind of like it's a kind of a silly tagline, but it's actually maps in with the COP this year, right? How are we actually doing this? And again, so I think I'm optimistic because so many people are asking this question. So many people are coming to us asking to help implement net zero in their portfolios. And not everybody agrees, by the way, right? Europe's way out here. Europe's been dedicated to this for many years. America's mixed. And I'd say, Asia and the Middle East is coming to the table in a pretty big way. Europe's definitely the leader, right? But again, things are moving really fast, right? We've also got huge technological advancements. Like you just said, right? Like 10 years ago, what you just talked about, a phone and a solar panel couldn't work. And now we've got that. So that's why I'm optimistic about all of this coming together. We're making real change that wasn't happening just a few years ago, right? So I think it's good that everyone's scared. I think it's good that we're all worried. I think it's good that we're talking about 1.5 isn't going to happen anymore, right? We need a bit of scare tactics out there. The war is good because it's a carbon tax, effectively, right? It's creating a carbon tax, so people are making decisions based on that. So, again, it's a lot of scary stuff out there, but with the technology and also the pledges and the commitments, the public commitments that people are making, I actually think we are starting to move in the right direction, but we obviously need to do it faster.
Thank you very much indeed. I think that's probably a good note on which to draw our discussion to a conclusion. If you like, necessity is the mother of invention, and we have the mother of all necessities driving us to do things differently. And in a sense, I think that what this discussion has showed us is new models are needed. We've heard about 3 new models, all of which in different ways are working. The GAPP. The Green Investment Group itself is a new model which has moved from public to private and is doing great work. The Climate Finance Partnership also is one that is really delivering and has capacity to scale and develop through new rounds. At the same time, those new models require new partnerships. I guess that's also a key theme of this discussion. I would say for AIIB as a relatively new institution, we see ourselves as having a role to play both in developing the new models and in building the new partnerships that are necessary to deliver the investment at the scale that's needed to support the climate transition in emerging markets. So I think this has been a fantastic discussion, extremely rich and informative. And could I just ask you to close in the traditional fashion by thanking President Jin, by thanking Anne, Mark, and Raj for their comments on the panel, and thank all of you for participating as well. Thank you. And I should say there are going to be a lot of events in this joint MDB pavilion hosted by many other multilateral development banks, as well as AIIB, we work in partnership together. We have to work more effectively together as a system, and this pavilion is one such kind of manifestation of that. So please come back, join in other events, and we will just have a quick photograph of the panelists, if we may, a formal position. Also, I'd just like to thank all of those who've joined online. Hope that you found this discussion as rich and rewarding as we did in the room. Thank you.